We've all experienced the gut-wrenching drops in our portfolio values, causing panic and making us question our strategies, posing the big dilemma on whether we should sell everything and cut our losses, or alternatively, we should hold for dear life. Well, in these regards, I would say that it's totally natural to feel overwhelmed, especially during these times, when the global stock indices, like the Nikkei for instance, plummeted 13% overnight, or the Nasdaq dropping 15% over 1 week. Panic selling can be tempting, especially when headlines scream doom and gloom. But what if I told you that having the right mindset can make all the difference? Learning from the best investor who ever lived, like Warren Buffett, Charlie Munger, Peter Lynch, just to mention some of them, can provide us with the wisdom needed to navigate these turbulent times. And this is a plus. Let's start with Warren Buffett, known as the Oracle of Omaha. Buffett's approach is simple yet profound and can be summarized in this motto: be fearful when others are greedy, and greedy when others are fearful. He believes in buying quality companies at a fair price and holding them for a long term. During market corrections, Buffett looks for opportunity to buy rather than selling.
Warren, again, for people who are just waking up, they're tuning in and they want to know what you think about this sell-off this morning. To see the Dow down 700, 800 points in the morning, what's your reaction when you see something like that?
Well, my reaction is that I like to buy stocks, so I don't wish ill on anybody else, but I like to, if they want to sell them to me cheaper, I prefer it. How can it be bad news unless you have to sell stocks? Now, if you have to sell them for some reason, you're worse off. If you don't have to sell them, I mean, somebody can come around and offer you a quote on your house today, and it could be 2% less than they offered you yesterday. But if you like the house, it really doesn't make any difference for you.
Second in the list, Charlie Munger, lifetime business partner of Warren Buffett, emphasized the importance of patience and rationality. He advised us against being driven by emotional decisions and focus once again on the long-term value of the investments. Long story short, Munger's advice was to avoid panic selling and instead concentrate on understanding the underlying value of our holdings. Because remember that the price is what you pay, but the value is what you get. Third in my list of favorite investors stands Peter Lynch, known for his practical approach to investing on top of his grey hair. Peter suggests that you should invest only in stocks and businesses that you deeply understand and have a strong conviction. When it comes to selling, Peter advises selling a stock only if the fundamental reason for owning it have changed, not just because the market is down. Now let's talk about my personal view, which align closely to those of my mentors, but with some little adaptation. I believe that as investors, we have the moral responsibility to consistently improve and achieve better results. This includes considering a second element on top of market correction, and I'm referring to taxes. Taking a long-term perspective is crucial, but is not always easy. Even Warren Buffett, that is known for his buy and hold strategy, has made decisions to sell stocks over time. And these decisions were often influenced by tax considerations and the need to protect his holdings, as well as the shareholders of Berkshire Hathaway, from the excess greed of the fiscal authorities. And just to give a fresh example, Warren Buffett just disclosed that he trimmed by 50% the exposure to Apple of Berkshire Hathaway. For this exact reason. For more information, I leave the link to the news in the description down below. Going back to the topic, one of the critical decisions we have to make is whether to liquidate our holdings and pay capital gain tax, or holding our stocks and whether market corrections. To help myself, I developed a dedicated model for this that is available for free download in the description down below as well. So if you want, you can play with it. The model aims to balance what is more convenient between selling or holding, according to three main variables: capital, performance, and tax rate. Playing a bit with the numbers can give us an indication to appraise what is the best point in time, maximize capital gain, reduce the tax impact, and mitigate the effect of a market correction on my portfolio. In substance, we can say that whenever the tax impact is lower than the potential impact from a market correction, we should opt for selling, and wait for a market consolidation to rebalance a bit our portfolio and take advantage from new potential opportunity to buy. Whenever on the other end the tax impact is higher than the potential downside risk coming from a market correction, we should hold our position, postponing in these regards the capital gain tax and leveraging as much as possible on the compound interest effect. Long story short, I found this tool extremely useful in making informed decisions because we usually do not take into consideration what we have to pay as ancillary cost as well as taxes. And trust me, the impact on our net return can be quite substantial. In conclusion, being a prudent and savvy investor means committing to your strategy and comprehend that success comes from dedication rather than constantly moving around and trading stocks. Because moving around, you cannot predict what the market is going to do in the short term, first of all. Secondly, we are going to be subject to ancillary costs, such as commission, fees, and spreads. And thirdly, we have to pay taxes on the capital gain, if we get lucky. So remember, as the great Warren Buffett, Charlie Munger, and Peter Lynch teach us, the key to investing success is stay calm, rational, and focus on the long term. So guys, we reached the end of the video. Thanks a lot for watching Beyond Alpha. If you found this video helpful, don't forget to subscribe, give a thumb up, and activate the bell to remain always updated on our latest financial content for more insights into successful investing. And don't forget to download the free model in the description. Until next time, happy investing. Cheers!